Good afternoon, colleagues. I hope everyone is fine. Welcome to the Riskworx collateral funding discounting webinar. It's a privilege for us to host this event. We hope that it will be insightful and it will be interesting. It will be insightful and it will be interesting, and we'll all walk away with something. We'll take something home with us. So by introduction, my name is Anthony Maleta. At Riskworx, I wear two hats. I look after the operations of the business, but today I'm wearing a financial engineering hat. And perhaps before I start with a bit of a housekeeping, I just want to introduce our presenters today. We have three people that are going to be presenting. We have Pierre Gravellini, he heads up our financial engineering or consulting at Riskworx. Ashley Kanter, he heads up our RiskLab, as well as Mr. Wilbur Langson, who heads up front office quants at Absa Global Markets. I see the guys have switched their video on, so you get to appreciate who they are. So the second aspect that I'm going to move to is a little bit of housekeeping. When we host this event, we always try to encourage people to participate and ask questions. We learn from each other. So what we've done this time around was to make it a little bit easier. If you look at your screen on top, you'll see a little S there. I think the idea is to click on it and start asking our presenters questions, and at some point during the presentation, they will then take a pause and they'll answer your question. And you're welcome to grill them. These are people that have been in the market for many years. Yeah. So without any further ado, I will then introduce our first presenter, Mr. Wilbur. I think he's got some interesting things that he wants to share regarding the research and the webinar that we hope it will foster discussions. Over to you, Wilbur.
Thank you, Anthony. Could you move to the slides, please? Thank you. Next slide.
Looks like you're back to the top, Anthony.
Oh, I'm no longer in control. I think you are here.
Okay, let me take control and do that. Sorry for this little. All right, so here we go. So, Wilbur, over to you.
Thanks. So the research that will be presented originated from some back and forth chats that we had with Riskworx. So I'll make a few introductory points just to frame the importance of the research. Now, there are a number of instances where we trade the same product on different venues. So I'll give you an example. It could be a USD interest rate swap traded either on CME or perhaps LCH, or perhaps even bilateral in the OTC market. This then raises the question, should we build separate curves for each venue? And perhaps to be more specific, I'm not just talking of different discounting curves. So for example, the discount curve for LCH, SOFR, and a discount curve for CME SOFR. But should we maybe also even just build distinct forecasting curves? So, should we be building a USD LIBOR 3-month curve for LCH trades, and separately a USD LIBOR 3-month curve for bilateral OTC trades? Of course, these would be built, if we did choose to do so, these would be built using only instruments traded on the given venue. And yeah, intuitively one might say, but you know what, there's really only one LIBOR that fixes in reality. So how can we have multiple forecasting curves for different venues? Although that answer sounds good, it's not necessarily theoretically sound. I think, and this is what prompted the research, I think the answer is a bit deeper. And I think it would benefit from a review of the theoretical foundations of the multi-curve framework, as well as empirical analysis. Could you move forward, please? Okay, so I don't know what the answer is. That's why this research I think would be interesting. But whatever the answer is, it needs to be overlaid with a balance between, one, accuracy in repricing trades versus practicality and even considerations of the capital impact. So I mentioned three things. Let's just go through them. So firstly, accuracy in pricing. I think that's easily understood and needs no further clarification. If, for example, you used one curve, it might not be accurate for across all the venues. If we move to practicality, so yeah, for instance, you might find that many systems are hardwired to use only a single forecasting curve for a given market rate. And, you know, if the conclusion of this research is that every venue needs its own curve, you might find that from a practical perspective, you might need to implement hacks in your system to have things like multiple forecast curves. So one example of a hack is you might have to give different forecast indices different names. So you'd have a Libor 3-month LCH, a Libor 3-month CFE. They're forecasting curves for the same fixing rate in the market, but you know these are the sort of hacks you might have to do to practically implement such a thing in your system. Now, the third consideration is the capital impact, and here an example is, you know, simple timing mismatches between snapping of closing rates across different venues could introduce fictitious noise in the time series that you use for historical VAR and thus distort the true nature of correlated movements. What I mean by that is you might have a forecasting curve built off LCH, a forecasting curve built off CME. They should look very similar, I would hope, or not. But embedded in that are other things like timing mismatches that could distort the time series and introduce additional capital, simply because maybe you're snapping the one at 3 and you're snapping the other one at 4. Now, given all of the considerations above, Riskworx then directed research focus towards a theoretical and empirical study of these issues at hand. Absa did assist in providing some of the data and gave some research guidance. As a caveat, though, the views do not necessarily reflect pricing practices within Absa. Thanks, Anthony. I'll hand back.
Thank you, Wilbur. For the purposes of this research, we felt it might be a good idea to go back to first principle and to refresh our memories. I think that the idea of a multi-curve is an ancient one, but we also felt it's important to just go back and think about where we come from. So I've summarized a few slides of the history of the multi-curve, and I think the genesis of it is the 2008 financial crisis, the worst crisis probably arguably since the Depression of 1921. And Goldman Sachs in 2008, they concluded that all cash collateralized trades will be discounted using OIS. And a very handful of people found out about it and made a lot of money. And now today, this OIS has become a sort of a market standard. Cool. So on that, we've taken two views. We've just wanted to summarize very high level, just to refresh our memories, the difference between the single curve and the multi-curve. And it really comes down to the approaches. The single curve, only one discount, the discount curve and the forward curve is similar. Whereas the multi-curve, you've got a discount curve and multiple forward curves, the different tenors. As an example of that, suppose that you've got a transaction, which is a euro swap that is collateralized in USD. The cash flow of the trades are in euro. However, the collateralized is in USD. And hence the rate of remuneration of collateral must be in USD. And that rate of remuneration is your USD Fed funds, which is your OIS. This is equivalent to saying that the transaction is funded in USD, and as a result, the discounting of the euro swap is a Fed fund equivalent rate constructed using a cross-currency cash flow swap. So I think with that background in mind, I will then hand over to Pierre, who will take us through some of the assumptions of the multi-curve, and hopefully we can have some interesting discussions. Over to you, Pierre.
Perfect. Thank you, Anthony. Good afternoon, everyone. Let me move the slide. Okay, so what we've done is we've started to list some of the key assumptions, and this is a little bit of a revisit of multi-curve framework. There are a lot of things happening in the market, as Ashley will take us through, that can change the way we are bootstrapping. So what we wanted to do first is to list these assumptions and started to explore them. Think, how do we prove or challenge these assumptions with data? So as you see, this is research which is, as you will see, this is research that is still in progress, and and that requires a bit additional thinking, but we are already highlighting some interesting takeaways. Okay, so first, I think Anthony spoke about the birth of multi-curve and the story around Goldman. And I think this is quite interesting for one of us that have been around in the financial markets in 2008. I remember at the time I was a quant in the fixed income team, and I remember working on the intricacy and the implementation of OIS discounting at HSBC. And I think this thinking was almost an evolutionary one, at least for myself. There was first a thinking that with the credit spread increasing in the market between the overnight curves and the Libor curves, and even within the different tenors, 1 month, 3 months, 6 months Libor, for instance, the idea was to say, okay, this Libor rate, the 3 months Libor rate that we've been using for discounting is not representative of risk-free rate anymore. We should move to a better representation in OIS. And this was kind of the first explanation that I myself integrated as I was discovering this topic, as it was uncovering into the markets. But then, thinking a bit more about it and deepening my understanding, I realized the link to collateral, to CSA, and the fact that when you have a cash flow which is collateralized in dollar, you basically, if you assume a perfect CSA, you have the cash to fund your transaction. What is the cost of this funding? Is if you receive the collateral, you have to pay a rate of remuneration on top of the collateral. And so this rate of remuneration, which as part of the legal jargon of the CSA, of the Credit Support Annex, is OIS, is driven by, so the rate of remuneration is driven by the legal document, and this is standard way OIS. And actually at the time, when we started to uncover that and look at the legal document, you had some discrepancies. I remember CSA quoting, OIS plus a spread, Euribor plus a spread, etc., etc. So this was not standardized at all, but the majority of the transaction were with OIS. And so this was the second justification of an OIS discounting. So not so much linked to credit and representing a risk-free rate, but more looking at a collateralized transaction. If you have cash against a certain cash flow, this is becoming a way of funding this cash flow. What is the cost of funding? Is the rate of remuneration of the collateral, which is most of the time OIS. So this was exactly my thinking and the steps I went through to understanding this problem. But this opened almost another Pandora box, which was, what are the specific features of the CSA that can impact valuation? And so you had then, things like one-way CSA, optionality in terms of collateral that you can post. You had all of this optional termination as well, and all of these different features of the CSA, and even the ISDA. What is the rate that you're going to use for valuation when there is a default? And none of these started to make its way into valuations through discounting, funding adjustments, and credit adjustment as well. So this link between, if you want the legal word, when came into very obviously and visibly into the realm of valuation and risk. All right, and this actually, all of this complexity and all of these differences in CSA started to drive the need for standardization, and the regulation started to push for a standardization of CSA because of all of these different features that could have an impact on valuation and risk. So the point of all of this is that collateral really matters in pricing, and more than that, there are some other features in the CSA that do matter. So from that, we started to list, okay, when we do bootstrapping and multi-curve bootstrapping, what are the assumptions that we're taking? So the first thing is that when you get quotes from the markets, let's say one of our favorite provider, Bloomberg or Reuters, what is this quote? So you see a swap rate. What's the assumption, the discounting assumption behind that swap rate? And if you actually look on your Reuters or Bloomberg screen, it's not that easy to find. But generally, people think that this is a quote in the interbank market, and the interbank market is collateralized in a standardized way, which is referred to as perfect collateralization or gold standard, where the trade is collateralized in the currency of the trade. So if you want, when you see a quote, often we assume that this is, if you look at the USD Libor quote, this is collateralized with dollar collateral, and the rate of remuneration, whilst Fed fund is moving to SOFR. But this is not that explicit. So this is the first thing. When I receive my quotes, what is the discounting assumption? So this is the first discounting assumption. The second one, which Wilbur referred to, is what we've called forward of forward. So the idea behind this, which Wilbur explained, is that if you have one fixing and the forward is the expectation of where the floating rate is going to fix, then it makes sense to have unity of forwards. That being said, we see in the market a lot of spreads. You have spreads between brokers, is it timing, but you have more importantly probably spreads between CCPs, for instance. So when you're facing LCH or CME, the quotes that they provide are not exactly the same. Actually, the spread between two clearinghouses are quoted, and you have spread between clearinghouses and bilateral, etc. Where does that come from? If you have the assumption that forwards are forwards, then it should come from the discounting. And so what is explaining that change in discounting? So this is an interesting assumption. What probably you want to have is still a convergence towards a unique forward as you get closer to the fixing date. So we thought, okay, if we want to test this assumption, so this is an example, sorry, just before we go to the testing. So this is an example which I think we mentioned, but if we have a USD 3-month Libor swap, for instance, I take a quote from the market or a yield curve from the market, a list of quotes, swap rates. Then I'm going to assume that this is SOFR discounting, all of these quotes, and I'm going to do a multi-curve bootstrapping. So it's basically simultaneous bootstrapping, if you want, where when you derive your zero coupon for your Libor 3 months, you assume another discounting curve, so you pull in the SOFR curve in order to do your bootstrapping. Once you've done that, you freeze your forwards. You say, okay, these are my forwards, and because they represent the fixing, they should be unique. And so what you do is if you price a swap against LCH, then you're going to take this discounting assumption of SOFR, and as a result, you're going to retrieve your par rates if you price a market swap. However, if you price, for instance, a USD 3-month Libor swap, let's say the same one, which is in bilateral CSA, as an example, and maybe in this market, bilateral CSA have not moved to SOFR yet, but still on Fed fund, then you're going to have a price for the same swap which is non-zero, reflecting the fact that the discounting is not SOFR anymore, it's Fed fund. It is not in line with the discounting assumption that you have used in order to do your bootstrapping. So that's one way of thinking about it. So if you push the assumption of forwards are forwards to its conclusion, you basically reflect the difference in pricing from the change in discounting curve. That being said, as Wilbur mentioned, it might be more complex than this. And there might be other things coming into different swap rate that we see, and it might not be all reflected into the discounting. So how to test this? So what we did is we shared. So this was a work, as I said, which is still in progress, and it's in collaboration between Riskworx and Absa. So we used data, historical data of Easter curve. So they had we had two types of Easter curve, facing bilateral market and facing LCH. Then we had Sonia curves, SOFR curves, and so that we refer to as discounting curve. These are the ones that are used for discounting. And then we still have in this study the Libor curve. So obviously with the risk-free rate reform, etc., this might change. This is what Ashley is going to explore in the next section. However, for now we've used these Libor curves as well, again for USD, sterling, and euro as well. And so what we did is we looked first at the risk-free rate curve. and SOFR curves across different brokers, and then also facing LCH versus facing the bilateral markets. And we compare them and see if there were any differences between them. And then we bootstrap the forward curve, so the Libor curve, using the relevant discounting curve as well, and started to compare the zero coupon of the Libor curve. So there are a few slides. We will share the deck with you that are showing these results. So I'm going to, in the interest of time, don't go through all of them. But this is basically looking at the SOFR in the bilateral market across brokers. And what we've seen is that the quotes are very consistent, and when there are some differences, they seem to be jumping around as if it was a timing issue, but there's no consistent spreads across broker, which is probably showing that the brokers are quoting in the bilateral markets in a consistent manner. And then the next step was to look at, so we've looked at all the currencies, and the conclusion is roughly the same, or is the same. And then the other thing that we've looked at, so I've jumped a few slides just to look at the last one. We've looked at the bilateral versus LCH. And so do we see a spread, between bilateral and LCH? And for the risk-free rate curve, so we've looked at Esther and Sonia, these two are very consistent. So we don't see material spreads across bilateral versus LCH for the SOFR and Sonia and Esther. I think it's like we look at. So the next step, which we haven't done yet, we are still collecting data, is to then look at bootstrapping. So look at the swap rate curve between LCH and bilateral, where we are observing spreads, and then bootstrap them and look at the forwards that we get from them. So this is the next step of the research, really to test the assumption of forward FR. Okay, let me move on in the interest of time. So these are other assumptions that we also listed. We haven't really started to explore them, but do you have liquid market codes, and is the liquidity between the different codes that you're using? And sometimes, in some of our infrastructure, we have a process of spread. So you have a risk-free rate curve, and then you derive, your other curve with a spread on top. So is the liquidity across tenors and across the different curves playing a role or not? And then, other assumptions, so homogeneity of the forward curve, asset price and prices in continuous time, the interest rates associated to each instrument is deterministic, the basis spread also assumed to be deterministic, etc., etc. So all of this is assumption that we want to review. On top of the forward, the one that we have started to question and really work on is the independence of the spread between the discount curve and the forward curve. So here what we looked at, to make it a bit more clearer, is we've looked, for instance, at Easter and Sonia, and we've looked at the spread between Easter and the 3 months Euribor, and the spread between Sonia and the 3 months GBP Libor. And what we looked at the correlation between the two. So is there a need for a correlation between these two entities, between the reference rate and the spread, or what we normally do to assume that they are not correlated, they are independent, is accurate? And so what we see is that first, so I want to say that the time series was a bit short. We only had about, I think, 20 or 30 days of data, so we need a much longer time series. But we start to see, we've seen some correlations. They are quite low if you look at the daily change. So I think it's around 10 to 25% for euro and 15 to 30% for GBP. So, not high correlation, but they're still there. So we need to probably, go further and do a bit more testing around the correlation, use a wider set of data, and then look at this correlation in more details. But yeah, this is the kind of thing that we are driving in terms of the research that we're doing with Absa, is to look at each of the assumptions and look at ways to infirm or confirm them, and then think about what's the impact on the infrastructure, on the pricing, and on capital as well. And I think we're working on curves now, but if you have a situation where you decide that actually I'm going to have multiple forward curves for each of the type of counterparty or type of collateralization that I'm facing, what do you do then for volatilities? And I know that in South Africa the auction market is limited to a few currency, but do you need then to have different volatilities for some of these curves? That could be the next step in terms of this thinking. All right, let me stop there. I think what we wanted to do now is to have to get a bit of your opinion, and so we've put some polls for you. So again, if you go on the top of your team screen, you should have an icon with the S, which is Slido. And if you go into Slido, we're going to launch the first poll. I'm going to do it now, where you can actually go and answer the question.
Pierre, can I just add? We already have a question from Stefan. I think all three of you can take a stab at it. The question is, by constructing different curves for each venue, can you guys see the question?
It just disappeared now. If you go to live, Anthony, you should see it. If you switch from review to live. So by constructing different curves for each venue, does this introduce a constraint to all of our edges must lie within the same venue, or this is not affected? Yeah, I think that's a really good question. I think it's from Stefan. Yeah, for me, if you do that, then you introduce a lot of bases, which are going to impact your edges. So you might not want to have perfect consistency, and so if you have a bilateral swap, it's a bit like what you have today between your non-collateralized and collateralized world, where you have in the collateralized NOIS discounting, and in the uncollateralized world, I guess most of us, we're still using Libor, moving to a funding curve probably. You introduce a spread between the two, and then you have to manage this spread. And the idea is that you start to have market instruments to manage the spread, at least OIS Libor for now. So yeah, I think this will create a basis. But Wilbur, Ash, I don't know if you have another view on that one.
Yeah, I more or less agree with you, Pierre. I think looking ahead, we don't know the answer yet, but we'd like the answer to be that we don't need to build different curves for different venues. However, if we do see that the market prices it with significant basis, which might also be the answer, it does draw into question whether you could hedge risks on one venue with trades on another venue. Now, we would hope that you could partially hedge it, but it might not be 100% effective hedge. And, you might have to, we certainly don't see inter-venue basis trades happening, but it might be the case that you do need to start hedging for this inter-venue basis. But yeah, that's all I have to say.
Yeah, and then if you see the differences, the basis between, for instance, let's take an example. I'm placing one trade LCH and another trade CME. There is a basis between the two. Is this basis driven by both the forward and discount curve, or is it just a discounting and the forward are the same? Depending on what assumption you have or you apply or you can prove, this will create different basis that potentially you have to hedge. Ash, do you have any other views?
Yeah, look, I mean, I think nothing necessarily to add to that specific topic. But, I do think there's certainly some crossover in terms of, I guess, the structural impact of curve construction and pricing in terms of what we're talking about. So I think you start from quite a neat theoretical background. But I think there are practical considerations around the way that the market changed that obviously have varying degrees of impact, and I guess the level of impact that those structural elements have ultimately drives what you need to incorporate into your pricing.
Perfect, thanks, Ashley. So yeah, on the Slido question, so it's if you have voted, so I think 9 people have voted. Sorry. We are about 30, on the call, so don't be shy. Please vote. I think it's going to be interesting to see your views. Again, the question is, what impact can the assumption underpinning multi-curve have on valuation and risk? So to access the voting, again, you can click on the S, the Slido icon on the top towards the right, and then you can vote and see the results as well. So I see vote coming in, but so far, people think that this can have a material impact on valuations and risk. So interesting. So I'm going to leave the question open to gather a bit more votes, and maybe in terms of presentation, hand over to Ashley.
Cool, thanks, Pierre. So, I mean, as I said, I think it's I'm going to be looking a little bit at, you know, some of the structural elements that pull us away from quite a nice theoretical approach to valuation in a reformed rate world. And what I'm talking to is actually some tables that we were using as part of a previous webinar around the rate reform. So you'll see there kind of a few open questions there. And really, although I think we're kind of moving towards a state of getting better clarity on that, I think for a lot of participants in the market, these are things that are still undecided. So what you'll see is, sorry, just waiting for control to take. So, I mean, really what you're going to see is the kind of the standard tables that we've been looking at in terms of the way that the market evolves from a pricing perspective. And really the one that I think makes the most sense to talk to, so, you know, we've got for the euro rates, etc., is going to be kind of the US SOFR, so the Libor transition. So essentially here, I mean, I think if we look at where we stand today, or, you know, where the market has potential to go, we move from a simultaneous bootstrapping world with a number of different term rates to effectively a world where we are largely dealing with SOFR as the underlying reference rate, and that being self-discounting. So that it simplifies a lot of the processes that need to take place from a discounting perspective. But then, and I think where we've kind of seen the demand particularly, and you see it's kind of in terms of the way the market's evolving, is really there is demand for a term SOFR, and that's been accommodated to a certain extent. Yeah, so that's been accommodated to a certain extent. And really, I mean, I think the quantitative community seem to be quite comfortable with just having a single SOFR reference rate. But from the treasury community, I guess based on the assets and liabilities that they're managing, it seems like there's strong demand for term SOFRs. And then obviously there's been accommodation made in terms of the way that reform has taken place to allow for, let's say, particularly loans and deposits written on term rates to incorporate those term SOFRs into their pricing. And then more recently, obviously there was the introduction of the formal term SOFRs, both in terms of reference or advisory from the ARC, as well as the introduction of the products on CME and the futures written on those term SOFR rates. Now, I guess kind of where it seems like we stand at the moment is, although the ARC advisory around term SOFR seems to indicate that they don't necessarily want too much liquidity or too much a trading activity dedicated towards the term SOFR, ultimately that market is probably going to evolve according to demand. And, you know, if I was forced to almost like put down an opinion, it would seem that term SOFRs are going to be here to stay. So I think you end up in a very similar world to where we stand today, which you would have multiple term SOFR curves in terms of your forward rates. Obviously, I guess standard SOFR being your dominant reference rate, but I certainly think you will have a simultaneous bootstrapping world as well as multiple curves for valuation, both from forward and discount. And then that's not to ignore the fact that, you know, even from a standard valuation perspective, you are still going to have a multi-curve framework in terms of needing to value your trade set according to collateral posted against those trades. That's not necessarily going to be consistent with the currency of the trade. The other interesting question, and I think there's probably a little less going on here at the moment, is in terms of kind of the South African rate reform. So, I mean, I think we're really sitting very much in a wait and see state at the moment. So I think the last publication from the SARB was probably a draft publication from around the middle of last year. And that really seems to be, you know, almost aspirational. I think they talk a little bit about corresponding rates, so seeming to aim for a very consistent framework to what's taken place internationally. And then, yeah, I mean, I think you've got reference to, it's quite cumbersome, Azar's fur rate. So hopefully names around that change. But I mean, that's really in its infancy. And I mean, I think we discussed in kind of the previous session whether there will also need to be structural reforms to our repo and buy-sell back market to accommodate a kind of corresponding secured financing rate. So it's going to be interesting to see where that goes. I mean, I guess the SAFEX overnight rate is playing a pretty significant role in South Africa at the moment, but that's really, I think, the extent of the.
Thank you, Ashley. Okay, so what we're going to do now is I thank you for voting on the first question. I think it was interesting to see that the majority thought that these assumptions that we are exploring can have a material impact or some impact. I think we will split between these two. I have launched the next Slido question, which is multi-curve bootstrapping still relevant in the context of the risk-free rate reform, given both discount and forward will be derived from the same risk-free rate curve?
Hi,
and
Pierre,
so votes are coming. Yeah.
Yeah, there's a question from Shamim, and I think it's on Teams. Could we explain away the possibility of a different forward curves on the different exchanges by potentially differences in the initial margin requirements on these exchanges or other funding consideration?
Yeah, I think that's a very good point, and this is something that I do believe that what we call the basis spread between the CCP basis, so the difference in quoting between the different clearing houses, is probably coming from initial margin requirements, maybe default funds. So it comes from a funding point of view, if you think. So is it coming from forward or discounts? I don't know, but I like to explain it that this is coming from funding requirements such as the IM, the initial margin. And again, this is my assumption and me trying to make sense out of it, but it might be a forward difference as well. So that's my own view. I don't know if Ashley or Wilbur, you have some inputs to that question.
Yeah, Pierre, so I think it could certainly come from different methodologies for determination of initial margin across the exchanges. I have also anecdotally heard that it could be driven by the types of participants that favor the one exchange versus the other. Can't say I exactly understood that argument, but it revolved around asset managers being positioned in a particular direction on one particular exchange, and they drove prices in a particular way. I'd like to think that it's perhaps dominated by the initial margin differences, but I have heard other, and like I said, anecdotal reasons.
Ashley?
Yeah, look, I mean, I think it's pretty in touch with similar arguments to the ones Wilbur mentioned. You know, I mean, I think one of the interesting things, or one of the really tricky things to do, would almost to be to have a pricing framework that is able to incorporate that. And then I think the question is whether there's actually enough information or activity in the market to really be able to determine the rate absent those margin considerations. You know, so I mean, if you accept that, I think it does make it makes your bootstrapping process, I think, even more complex.
Yeah. Yeah. So I think what I want to add to this is we are quite keen at Riskworx, and Wilbur is also showing that there is some interest as well on his side at Absa to explore these assumptions. So is the CCP basis coming from initial margin? And so what is the work that we need to do to confirm this assumption? So maybe dig into the IM methodology, get an idea of, depending on the swap, the CCP that you're facing with the IM requirements, etc., etc. So, but if you have ideas on how we can, test this assumption, I would be very keen to hear them, either within this webinar or, or after. We have actually given you the possibility as well to unmute your mic and ask questions directly as well. And I want to remind you that we are still voting on Slido. So at the moment, on the next question, we've gathered eight votes. Anthony, any questions coming through? I think monitoring the different.
Not yet.
I think there's one question in Slido actually, and that I'm opening it. So it's opening slowly on my side. Question. Okay, so what is the outlook for JIBA? I'm gonna ask Ashley to take that one.
Yeah. Yeah. So look, I mean, I think as I said, so we're aware, or I think there've been a number of committee meetings specifically around the reform. To be honest, I'm not 100% in touch with when the last of those meetings were, or necessarily how that is progressing. But as I said, I mean, I think the most recent formal communication that I've really seen around that is the draft publication from the SARB. So that's just kind of reiterating their intention to reform the reference rate landscape in South Africa. And, it looks like that's likely to follow something quite similar to what we've seen internationally. And then obviously, I mean, I think one of the things to note off the back of that is, depending on what actually does happen internationally, that may very well change the outcome. I mean, I think they're almost getting the benefit of rather not necessarily being kind of first, but rather following suit with the direction that Europe takes. And I mean, I think the last time we had one of these conversations, or rather quite early in this process, was shortly after the SOFA surge. And that's certainly a data point that will have fed into their thinking at that point in time to try and decide whether that's a route they actually want to take. Probably now that the market has started to become a bit more orderly, I guess it looks a bit more appealing.
Thanks, Ashley. Okay. So I'm looking at the question around, the future of multi-curve bootstrapping when we complete the Riskworx reform. We have gathered 13 votes, and so far, people believe that we will still have multi-curve even when transition is achieved. So again, the idea is that if you are in a world where only, let's say, so far is used, then we go back to single curve bootstrapping. But it looks like most of us, we're not completely certain of it. There was a question and answer which was yes, certainly. Only 8% of the 13 votes, I think that this would be there for sure. But most of the people, 69% of us, we believe that this would be there probably. Okay, I see that there's another question that came in. What has been or will be the impact on pricing libraries and IT infrastructure? What are some of the risk issues with implementation? Wilbur, do you want to give a first go at this question?
Sure. So I think we discussed a number of things, and I'll try and contain the answer. But I think on the issue of different curves for different venues, if you believe that's the case, for example, you might have to change your pricing libraries to accommodate the fact that you have multiple forecasting curves depending on the venue. And again, I mean, should one have multiple forecasting curves for the same underlying? It's quite possible. We know that under measure changes, forecasted expectations are different. And if the solution to this problem is actually different exchanges imply different measures, well, then it's entirely plausible that different exchanges could imply different forward forecasting curves. In terms of the assumptions on multi-curve discounting, so I think somewhere in the presentation we did mention, and there's a guy by the name of Mark Enraad who does a lot of research on this. He, for instance, if you read some of his papers, and this was mentioned before, one of the assumptions in multi-curve, call it the multi-curve recipe, because there's a couple of ingredients, we throw it in the mill and we do it. But one of the assumptions is independence of the spread, of intercurve spreads and overall curve levels. But let's say in the extreme case that, you know, empirically we check that and it doesn't hold, I mean, that could be quite nasty. It could mean that, for example, we start building curves where one of the inputs into the curve build is some correlation parameters. And when we start talking correlation parameters, hopefully we solve this using maybe heuristics or analytic solutions, but it could look as ugly as having to do Monte Carlo type curve builds where you actually parameterize this dependence in some model, and you actually need to do Monte Carlo type curve stripping. So, depending on your view and, the answer, or your view or the data that you're using and what you believe, it could vary from trivial hacks in your system to fairly ugly implementations of curve building procedures. Thanks.
Thanks, Wilbur. I think so. Great answer.
Any
comment on this?
There's another question that has come through from Shamin on the chart.
Yes, so I was saying that there's quite a lot of uncertainty, and I think this is for us to drive this kind of discussion as well. To think about what's the orderly transition away from USD Libor in the cross-currency swap market. But let me see if Ashley or Wilbur have some views on this.
Yeah, so certainly I'm not going to answer the question directly initially, but certainly on cross-currency swaps, and I'm sure most other guys on the call have been asked to infer par rates for Libor for JIBOR cross-currency swaps, not discounting all Fed funds or not collateralized at Fed funds, but collateralized at SOFR. So we have been asked to build pricing around that. In terms of whether we're seeing requests for pricing around cross-currency swaps where the USD leg is paying compounded SOFR, to be honest, Nicole Holder is our expert on this, and she's been involved with the traders. I don't know if she's prepared or happy to jump in and just give a overview indication of what she might have seen or been requested from her. Maybe not. But yeah, I think we certainly have been, if I'm not mistaken, we have been asked to imply quotes for USD legs paying compounded SOFR as opposed to Libor 3 months.
Thanks, Wilbur. That's very interesting. Ashley, do you have anything to add?
Yeah, not much. It's I mean, I think it's kind of clear that's the direction things are heading, but uncertain as to when the real switch takes place.
Yeah, and I guess uncertainty around the legacy portfolio as well.
Yeah. Sorry,
so
so Pierre, one thing that actually does occur due to this question, and I mean, I think it's just an interesting question about the South African market specifically, that we've kind of discussed a bit, and is a little bit unanswered for us. I mean, so and I think there are a number of related questions around JIBAR and Rand rates particularly. You know, I think if you look internationally, really the clearinghouses and central counterparties have clearly played a significant role in terms of managing and driving the orderly transition around the reform rates. I think one of the things that's maybe a bit of an open question about how this actually plays out in a South African context is, although, you know, the JSE plays this role to a certain extent, we do not have a domestic CCP at the moment. So, you know, it's kind of interesting to think a little bit about how that transition is going to take place and be managed in the absence of a CCP, given that that's really been kind of the model that we've seen in play internationally.
That's a really interesting question. So yeah, what are going to be the driving force to have the discussion around cross-currency swap? I see that there are 2 more questions on Slido. Thank you very much for coming up with questions. I think I'm going to direct the first question to Wilbur and the second one to Ashley, if that's okay. I think Wilbur touched upon this in this first slide.
Yeah, sure. So certainly my own view is that it would increase things like standardized VAR. If you look at standardized VAR calculations, the more curves you have, the more punitive it is. I think the standardized calculations do give offset for curves in the same currency. But of course, it's not perfect offset. So I think every time you add more and more risk factors to your standardized VAR calculation, the imperfect correlation offset that you get is going to increase your capital charge. Thanks.
Thanks, Wilbur. That makes sense. Any comments on this? Again, don't hesitate to unmute and jump in. Any challenges as well? That's perfect. Perfectly acceptable as well. Okay, cool. Ash, second question. What do you think?
Yeah, look, I mean, 100%. I think this is one of the big challenges, or I think it's one of the interesting things about this transitionary period. So, you know, I think one of the things that's particularly interesting really is to have a reference rate of this nature that becomes your dominant reference rate. So I think that the very initial thing is really just according to what the regs and the processes require. So, I mean, if we're talking about like SVAR, you've got a time series challenge to deal with there. So that's really just the kind of first part of the problem. And maybe let's focus on that a little bit more than the IM question, because I think Wilbur kind of hinted at more curves is going to lead to higher capital. You're just not getting perfect offset. But focusing on SVAR, I mean, I think you've got this time series challenge from a regulatory and internal model perspective. But I do think that hints at something quite important, which is actually to say you're moving to a rate paradigm that you don't necessarily have a good sense of, or you don't have a good history in terms of behavior of those rates. And so, I mean, I think that's one of the things that is kind of the more interesting challenge. And, you know, if we think a little bit about the SOFA surge, you think about like dynamics in terms of secured rates and that interaction with liquidity coverage ratios. There's some quite interesting stuff that's taken place there that really has to do with the new rate regime. So although at the heart of it, you're dealing with a kind of a time series issue, I think the bigger thing is you're potentially moving to a completely new paradigm, and only over time are you really going to get a sense of what the dynamics of the reformed rates really are. Sorry, went a bit outfield there.
It's good. It's good to share this thinking, I think. Perfect. I hope that answers the question. Please keep coming with questions. This is great, and also don't hesitate to raise your hands if you want to add anything on some of our answers. Maybe looking at the Slido, pools. Anthony, I don't know if you can see that, show that on the screen, just to see where we are.
I see that on the screen. We've got about 13 people. So far, the majority seems to think that the multi-curve will be relevant in the near foreseeable future.
Okay, perfect.
But
okay.
we also have a question on Teams, eh?
Okay, great. Let me launch the next. I see people are still voting, so let's leave this poll on. Okay, so we have one question on Slido and one question on the Teams chat. So Ahmed is asking us, do you see any complication coming from the fact that other markets have moved over to SOFR, over to using SOFR when quoting cross-currency basis swaps, while the ZAR market still uses a Libor? Okay, so I think that's a question that we slightly touched on, when we discussed the move of cross-currency swap, but this is more specifically. So if we, assume that the ZAR market stays on Libor versus JIBOR, but other international markets for other currency pair have moved to the SOFR versus whatever rate it is for the other currency, is that a complication? That's a good question as well. I think the point is that if you assume, for instance, let's say AED, I have no idea if the AED market has moved to quoting against SOFR on the cross-currency basis, but let's assume this is the case. Please don't hesitate to give me another better example if that makes sense. So let's say we look at AED. I think if you look at the AED versus JIBOR cross-currency swap, the way most of us are pricing that is assuming that you have, you go through a USD cross-currency basis, and in terms of discounting specifically, the USD coming back to USD is the norm when we price our cross-currency swaps. So if indeed the liquidity of the cross-currency basis is moving away from Libor for JIBOR, so it's staying on the Libor versus JIBOR, but moving away from the other rates, that could be an issue indeed. So I'm just, as you can see, thinking on top of my head. It's not something that I've really thought about, but I do realize that this is a good question as well to put on the list of things to cover. Again, I think if I try to summarize my thoughts, the convention in terms of pricing for cross-currency swap is to use dollar as a reference rate. So if indeed some markets are moving towards quoting against SOFR while others are staying again quoting against USD Libor, that might add some complexity in terms of the basis that you have to consider Libor versus SOFR, I'm guessing. Ashley, Wilbur, did my rambling give you some thoughts about this question, or do you have some actual inputs, observation on that question for a moment?
Yeah, not really, and maybe I'm not completely understanding the question, but we'd like to kill Libor off. We don't want to support the curve anymore, and it's an oddity that the market has not moved to, in bulk, well, not in bulk, but in any substantial form, start quoting cross-currency swaps, which is SOFR for JIBOR. I'm not close enough to the market to understand why, but there's certainly, from what we can see, zero to no liquidity in such instruments to even strip such a curve, and we do not have such a primary curve. We can try and imply it, but there's not enough liquidity to do it. I'm not sure if that answers the question, but the complication in my mind is just, we want to get rid of Libor, and it complicates our lives to keep this curve alive.
Thanks, Wilbur. Okay, Ash, are you happy to move to the next question? Do you have any inputs?
Look, I mean, I guess there is kind of inevitably, I guess that seems to indicate that there's probably basis introduced. I think you discussed that.
Yeah. Thanks.
So it's an interesting question.
Yeah. All right, now thanks for that. And then, so what we see in front of us is the result of the poll around Gibor and multi-curve. So are we going to still be using multi-curve in the future? I think we can see that there are still about 30% that are unsure, which is showing the kind of uncertainty that we have in our Gibor market. But most of us believe, close to 60%, that we will still have multi-curve. Perfect, thank you for that. Anthony Phillips, can we move to the next polls, just to change a little bit the question and see what's the next poll as well? So this is something that you can vote on. Do you think there is a need to consider different software curves when facing different type of counterparties? So this is again going back to the forward point. Would be quite interesting to see your, understand your views around this. In the meantime, I see that there is a question as well on Slido. Please, can you mention the challenges in implementing the multi-curve framework? Okay, so I think what we've done in the presentation is, if I try to summarize very quickly, Wilbur mentioned the different considerations. So from a pricing accuracy point of view, then from practicality. So if you have you push multi-curve to the extreme and you have many curves for different, for the same underlying, depending on the counterparty or the type of counterparty you're facing, and you still bring some complexity. And then we spoke about, which also came up in some of the questions around the impact in terms of capital of adding these complexity in terms of spreads and how to account for correlation in the capital framework. So this was in the first section. Then what we did is we listed some of the assumptions that you have around multi-curve. I think the way we puts it is that we look at the recipe and think about all the ingredients and the assumptions around these ingredients. And does that make sense in terms of and can we support them as well? So we have started, and we've only just scratched the surface. At Riskworx with some inputs from Nicole and Wilbur, to test some of these assumptions, specifically the idea that forwards are unique, so that forwards are forwards is what we've called it, and also the correlation between the underlying curve, let's say the software curve as an example, and the spreads on top of software to get to, for instance, a Libor curve. So do we have this is the assumption that there is not correlation verified or not. So these are the ones that we have started to explore. But I think as we were discussing with you and getting some of your inputs, we also saw other topics coming up, specifically on the cross-currency markets related to the risk-related reform and the evolution of Gibor. Yeah, I don't know if I have answered the question. This is almost a summary of what we've been discussing. Don't hesitate to let us know if you have any follow-up questions. Ashley, any comments on my longer monologue?
No, look, I mean, I think so. Obviously, there are additional challenges that are kind of more technical in nature. I mean, I think it's quite a finicky exercise, but these are some of the more interesting ones that maybe we don't always go into the detail on.
Yeah. Okay, and I see that 10 votes came in on the next slide. A question around: do we need to have different software curves when facing different type of counterparties? So I think someone in the chat used the term venue. I think I have the same, so different venues. So at the moment, the votes are taking towards probably not, which is quite interesting. Thanks for that. Please don't hesitate to keep voting. Again, you have a little icon in Teams to go to Slido and then vote, and also ask a question as well. Okay, I see a very interesting question around what would be the conclusions, what would the conclusion be if the assumptions are no longer applicable? So assumptions around multi-curve bootstrapping. I don't know if the person was referring to a specific assumption here, but But yeah, I think it depends really what can happen. But I think Wilbur mentioned that in terms of correlation, for instance, if you have to start to take into account correlation between the reference curve and your spreads, this could be quite complicated from an implementation point of view as well, and also from a risk. So basically, you bring correlation into the very first step of your evaluation of your pricing, which is the curve. So that's one example. But I guess each of the assumptions, if they are challenged, could have different impacts in terms of pricing, in terms of infrastructure, and probably in terms of capital and VAR. Wilbur, I don't hesitate to add comments on this. All right. So we have, going back to our polls, yeah, roughly the same results still. Probably not. Okay, any questions coming up? No? Any comments from any participants? Okay, we move to we had one last question that we had on Slido. Yeah, I think we've started to discuss a little bit about the next movement, what is happening and how this can impact multi-curve, or the other way around, if some of the assumptions are not verified, how this is impacting some of the changes that we are seeing materializing in the market. So that's an interesting question as well. All right. Wilbur, Ash, do you have any additional comments? Any maybe questions that you want to ask each other or myself?
Sorry, Pierre, there's a couple of streams where the questions are coming in. Are you referring to this question here that says?
No, I think we have exhausted all of the questions from the participants. We have indeed this survey or this poll going on in the background. But I was wondering if there were any other aspect that you wanted to comment on, or any question that you have, yourself, that maybe came up from the questions that we were getting, that you want to openly pose to the group.
No, nothing comes to mind. Let me go through some of the questions again. I think there was one question on SVAR histories and the fact that we don't have data for some of these risk-free rates in SVAR periods like 2008 and so forth. But I think that's a generic proxying issue. So, for example, yes, there's no data history, but like with other instances where you have a new risk and you don't have our history, yeah, you'd have to bring your proxying tools to bear on the problem. So you could do things like in the period where, for instance, SOFA and Fed funds have a common history, you could try and look for relationships between SOFA and Fed funds. Maybe SOFA volatility equals Fed funds volatility times 1.3, and then you can use that in your period for which you don't have data to transfer a proxy relationship onto Fed funds, for instance, to invent a SVAR history for SOFA.
It's an interesting one as well, yeah. Thanks for that. All right, perfect. So I think if we're not getting more questions, I think we don't have to try on for too long. But yeah, so hopefully, as Anthony was saying at the beginning, you got something out of it. Let me, ask Ashley and Wilbur if they have any closing comments, and then we can wrap up. Ashley, do you want to start? Do you have any closing remarks that come to mind?
Yeah, look, I mean, I think it's, you know, I guess kind of if I look at the experience of financial markets, you know, really, I mean, I think we've seen a lot of kind of these structural changes be quite transitionary. I mean, I think a lot of people are coming to the end of, you know, what they view as implementation of the rate reform. But, you know, that's a particular point in time. And, you know, I think there's going to be continual evolution probably for the next couple of years. And it's going to be interesting to see what direction that goes. You know, I think there's potential that some of these changes are quite significant structural changes, and we'll only have a proper sense of the full impact after a number of years of kind of operating markets in this environment. So just interesting to see which way it goes, and particularly from a South African context. It's
Thank you, Ashley. Wilbur, any closing thoughts?
Yeah, I think there's a lot of challenges in the regime that we set. I think what we've seen is that, you know, you've got to be more cognizant of wider impacts of pricing choices. So, for example, how you choose to build curves is going to affect your VAR calculations. It's going to affect things like your FRTB standardized calculations. And I think it's interesting in looking at the responses to the questions received. I think it's, you know, it's not we're not entirely in darkness. I think on average, there's 80% consensus that, you know, maybe things are not as bad or as complicated as they might be, which is a good thing. But I think it's always good to be mindful of the fact that you don't want to be on the wrong side of changing pricing practices.
Yeah, that's a very good point and a very nice hint to the first slide that Anthony shared with us with the birth of multi-curve and the what people call the OIS gold rush, with Goldman taking advantage of you know a knowledge that they had around, you know, pricing and discounting. So yes, it's a really good point, Wilbur. Yeah, so I think for me, concluding remarks, yeah, I think there might be a bit of a fatigue around, you know, OIS discounting and multi-curve, and, you know, we have adopted these assumptions and used them for a long time. Things like the risk-free rate reform are pushing people to rethink a little bit about these assumptions. Maybe, you know, as Wilbur was saying, these are not that material, and you know, we are happy with the overall, you know, consensus. But again, you know, it is important for us to think about these questions and make sure that you know, if there is a shift in the market, we are on top of it. So at Riskworx, we are going to, you know, keep working with Wilbur and you know, go through these assumptions and try to make progress in validating them. If you are interested, you know, in these topics, please don't hesitate to, you know, to reach out. If you have other assumptions that you think should be tested on priority, please also let us know. And obviously, any results, any interesting insight that we have, we'll share in some manner or another, probably maybe in the next webinar or in a different media. Perfect. I think this is wrapping us up. Anthony, Maleta, do you want to close off the
Thank you
discussion?
for that. No, thank you for that, Pierre. Thank you, everyone, for joining the webinar. We hope that it was insightful, it was interesting. I think we will make this deck available to those who are interested. And I think the meeting has also been recorded if you're still interested. And yeah, thank you very much.
Thanks a lot, everyone. And a special thank you to Wilbur and his team, and Nicole in particular, that have been working on this with us.
Thank you.
Thanks a lot, everyone.